Eric, we're back. It's great to see you. And I know this is a little premature, but happy anniversary.
You didn't even give me flowers, Austin.
Not yet, not yet. Officially, the 1 year anniversary, I suppose, would be September 12th, which is when you made your first buys in the AI investor portfolio. But congratulations on roughly, maybe by the time this episode drops, we'll be more or less at the 1 year anniversary mark. So congrats to you and to our listeners who've stuck around since the beginning. Any thoughts? Any thoughts on your first year in the portfolio? I know we're going to get into some performance review, but I'm just curious. How do you feel after this first year?
Yeah, I think our first show was August 31st, so we have crossed the threshold. You didn't even remember our right anniversary. That's what hurts the most. But no, it's been an interesting ride, Austin. For as much as AI has been largely up and to the right, when we look at where expectations were at the beginning of the show, especially with things like hyperscaler spend versus today, there is no question that the environment has changed to a materially higher degree. The portfolio, the returns reflect that in many ways. But also, at the beginning, we said we believe over the long run, this is going to be the biggest trend in human history. But this is why following a show and following a portfolio matters, especially if you haven't invested through these mega trends before, because there are going to be periods of peak euphoria. There's going to be drawdowns that feel incredibly uncomfortable, that you feel like, am I completely missing something? Am I in a bubble that's already popping? And we've experienced that with things like DeepSeek, with things like the tariff meltdown in early April. Many of the stocks that today are up 50% were down 50% or more in the span of months. So, it's been generally a very good environment for investing, and the returns of many stocks are up 30, 40, 50% or more. It hasn't been easy. And, that's why we want to provide a voice of sanity and long-term guidance to listeners. And I'm glad that we've been able to do that for a year. I hope we do it for many more. And once again, the best way to help us out and make this a community is to do things, ask us questions, leave ratings on the podcast. Everything that anyone does, it's really appreciated. So, that's my kind of just request to keep this going and make year 2 even better than year 1.
Thank you for that. What wonderful wisdom in there. I mean, any great investment has its, peak euphoria, peak trough. I mean, Netflix, Quickster, the tariff debacle, DeepSeek. I mean, name it, right? Every trend, every individual company has its moments here. So being able to go through those is really important. Eric, I know we're going to get into a portfolio update here, but I just want to do a little bit of housekeeping now that we're at the 1 year anniversary. Sorry, I got the date wrong. I suppose that makes this a true relationship here. But I wanted to reintroduce us to anybody who's joined us in the last year, right? You're Eric Bleeker. You're the portfolio lead on the AI investor portfolio. You've put $500,000 of your own money into work in the stock market, trying to position it to benefit from what is the largest trend, we believe, in human history. I'm the host, Austin Smith. The goals of this show are to share your investments and recommendations in the public space so that our listeners can benefit and participate with you on the growth of this trend. We're going to be getting into a 1 year portfolio update here. And if anybody wants to see the full portfolio, the portfolio is so large we can never discuss it in one episode. But if you want to see the performance or the current positions or the buys you've made or the repeat buys, anybody can go to 247wallstreet.com/AI portfolio. And as Eric mentioned, this is a growing community and we love interacting with our listeners. Send us questions. Please email us questions@247wallstreet.com or post questions, preferably on Spotify or YouTube, because while we can't answer every question, we appreciate everyone and our other listeners do as well. So ask us questions in a public sphere. We'd love to get our other listeners engaged too. Share your thoughts, reply in those comments. We'd love to make year 2 even better than year 1. With that said, Eric, there's always so much market news. Let's move to that a little bit. Let's talk about some earnings. And should we tease a portfolio buy at the end here? Are we putting some more money to work?
We're going to put money to work. I think the headline that's exciting, we've talked about this robotics opportunity. It's going to be our first buy in the robotics space. So we're starting to allocate some money there. So it should be exciting.
Well, I'm really excited about that. Okay, so you know how excited I am about robotics. That's been that's been the event horizon that I really want to get to here. So Eric, overall market news in August is pretty choppy. We've seen a relentlessly negative media sentiment. You pulled some really good quotes here, I think, that illustrate that. What are you seeing out there in the tone shift? And I'll just say anecdotally on the podcast I was listening to, I noticed maybe first week of August a notable chilling of the tone of guests and people in this space. And I forget when the MIT negativity paper came out, which I'll talk about as well. But it feels to me like this is maybe about a month old that maybe starting about a month ago rather the chilling began. What did you see?
First of all, it's worth noting we have said overall market conditions, some retrenchment is perfectly healthy, and in fact, we expect it to happen. We've seen some aspect of that in August. The market's relatively flat, but we've seen some kind of rotation out of a lot of momentum stocks. You're never going to win 12 out of 12 months of the year. You're never going to win every quarter. That's part of investing. You need to take some short-term losses if you want to have those long-term gains. So we think relatively some of the retrenchment in the market, that's healthy. Now, you mentioned the quote from the New York Times reporter. I'm just going to read it right here. He said, "I'm surprised by how much demand there is for GPT-5 is a bust slash AI is hang a wall takes. Some of it is wishful thinking or motivated reasoning, but some of it feels like a deep yearning for equilibrium. People really don't want to live in a world that's constantly changing." And also, I just thought that was really astute right now. You look at the motivation. We own a website for what you'd write to get clicks. 100% all motivation is tilted towards AI is a total bubble. It's about to burst. There's nothing useful from here. And I do think that does go back to really an innate need in humans. As he said, there is something deep and fundamentally changing that's uncomfortable. It's uncomfortable for me in many levels. I'm sure it's uncomfortable for you. And this is kind of what we do as people. If someone makes a list of the top sports teams, it's not so that everyone can celebrate, so everyone can say why it's wrong or, nitpick on it. That's a lot of what we're looking at in the AI space right now. So I think, we have media negativity. I'll let you go in on the MIT study a little bit more. But what I will say is this past week, we had what I would call the Super Bowl of AI right now, which is NVIDIA's earnings. I thought there was some really spectacular information there, some acceleration about this platform we've been talking about with Blackwell, and it really presents an exciting future for what's ahead in AI. So again, negativity out there in the media. We'll do our best to provide a really objective look at what's happened the past couple of weeks, but I'm seeing some things that are very encouraging from these earnings, even if stock prices aren't necessarily moving up in the short term.
Yeah. We certainly don't want to be Pollyanna-ish, and we need to keep a clear head in this environment. But when I see things like this, it feels to me a little bit to be like a case of sour grapes, right? Like we saw everything similar with cryptocurrencies, right? It's people don't want to believe that they've missed this trend, and that therefore it's easy to call it a bubble. And just further on some of the negativity, there was this MIT report that was published. It was called "The State of AI," which sounds really authoritative, and it had a conclusion that a lot of media outlets ran with. And the headline was 95% of generative AI pilots failed to produce meaningful results for the companies surveyed. That sounds like a really dire headline, but we're seeing very clear results that point in the other direction, right? Meta's ROIC has gone from 14% in 2022 to 18% to 20% to 2022 most recently. So 22% return on invested capital. So, and all of that while reducing headcount. So first of all, 95% of companies is not 95% of dollars in the space. We're very early here. We know that. But also, what would the headline have looked like in the late 90s or early 2000s if you were to look at web companies and their profitability or app companies and their profitability? Yet, we now have Uber, and we've seen what's happened with the iPhone and Google and other tech companies. Like, we are so early in this trend. This felt to me like shooting an arrow and painting a bullseye around it, and it's way too premature to call this technology a failure because 95% of companies that have maybe early adopted it haven't yet seen financial results. I also don't fully appreciate the methodology of this study, but this felt to me like people were looking for something. The media was looking for something to hang on to. The headline here was scary, but the actual reality we're seeing in company performance, at least at the public market level, is different.
Yeah, and I would say I would bet just about most people listening probably saw some headline about that MIT study. Almost concurrently, Stanford released a study with the exact opposite conclusion. I bet no one saw that. 100 to 1 media coverage ratio, which again, you need to realize what the incentives of the people sharing a lot of this information is. And again, it is highly incentivized to be negative. So I won't belabor the MIT thing, but it definitely felt like a lightning rod for this current moment that we're in.
Yeah. Yeah. Last point on this is maybe a little bit of just a experience that you and I have had over the last 15 or so years investing together. The pessimists always get to sound smart, right? It's a truism in investing. It feels good and they can make really intelligent arguments, but the rational optimist makes the money, right? There's always problems to find and point out why things won't work. But the people who are willing to be optimistic, to look to the future, to bet on human ingenuity, well, they end up doing a lot better in the long run. And that's what you're trying to do here. And that doesn't mean every investment will win, but this is the strategy to make money over the long run.
100%.
With that, as we're talking about making money, let's get into earnings, right? The Super Bowl of earnings, NVIDIA, solid quarter, huge rally leading up to it, though. So what did you see in the numbers here? We've got some complicating factors. We've got the H20 chip sales. Can they sell to China? Can they not sell to China? There's a lot going on with NVIDIA's earnings, but it is very much the bellwether of this industry. So tell me what you saw.
Yeah, and this is a good example where if you're kind of casually looking at the news, NVIDIA is basically flat. Maybe it was down 1% the next day, and it's slid in the aftermath of earnings as kind of a lot of selling has happened in kind of the broader momentum space. So you could be mistaken for saying, well, this wasn't very interesting earnings. The reality is this was an extremely interesting earnings. It was a very solid quarter from NVIDIA, and their stock was up 80% since mid-April headed into earnings release. When your stock is up that much, you can only kind of exceed expectations by so much. The other point, Austin, too, we'll analyze earnings on this show because they are important for kind of assessing whether or not the trajectory of companies is the way that you expect. But the short-term reaction, both in positive and negative senses, definitely tends to be an overreaction. NVIDIA has declined more than it's risen post-earnings over the past 2 years. In what direction is the stock chart, right? So if you were only investing the day after earnings, you would have incredibly negative returns for NVIDIA. If you had bought and hold, you would have been up several 100% at a minimum. I'm not sure on the exact numbers. Now, this quarter was extremely complicated because, as you had noted, analysts haven't known how to reintegrate sales to China. That's a very material area. You know, you often see reactions to earnings where a company might beat or miss by a few percent, causing 5 or 10% swings in share price. NVIDIA previously had 20% of sales to China. They're forecasting basically zero in the upcoming quarter. So they're removing 20% of their business. And technically, while they can sell to China, there's been geopolitical reasons why they're not factoring that into their guidance. So, Austin, if we remove China from the equation, I went through and I looked at the numbers. In the first quarter, backing out China of this year, NVIDIA did $39.4 billion in revenue. In the second quarter that was just reported, that was $45.5 billion. And their guidance for next quarter, Q3, is $54 billion. Austin, to put that in context, if you exclude China, that's 19% sequential growth, so quarter to quarter. Most companies would kill to have 19% a year. They're having 19% from quarter to quarter already at the size. And even if we do factor in the fact that they had some sales to China last quarter, not forecasting it next quarter, this is their highest sequential revenue growth in 2 years. So we look back at this journey, all this talk about NVIDIA's growth, it becoming the story stock of the market. Right now, they're experiencing their highest sequential growth in 2 years, which is really amazing. And Austin, the reason for this, we've talked a lot about on the show of NVIDIA releasing a new platform of chips, Blackwell, and that this would be the biggest technology launch in history. It's not going to have the same attention of an iPhone because there's no Steve Jobs on stage. There's no everyone with this in their pockets. There's no talking with your mom about whether or not she's going to buy the new iPhone. She's not buying a new Blackwell chip, right? But in terms of profit generated, in terms of how this moves the technology space forward, this is the biggest launch that we've seen. And all points show to this ramp happening earlier than expected and having massive implications across technology. One thing I'll note, Austin, too, when we look at Blackwell right now, they're already seeing this. I believe it's like 70% of their revenue already. Blackwell is just being used for running models. There's actually no customers using this for training yet. So that's an important point when we look at where we are on this ramp. It's still extremely early. The other thing I want to note, Austin, behind the scenes, A lot of selling happened in NVIDIA, as I know. They're up 80% since April. And the reason was earlier this year, there's a lot of chatter from the supply chain that Blackwell was generally disappointing. Customers were having a hard time with it. And that is true. This is why it's being used in actually running models. That's a lot easier than training, where you need to connect hundreds of thousands of chips together. So that's why we are mostly seeing that. But the other side, NVIDIA actually employs more people to improve their software than the actual chips. And what we've seen is an analysis from SemiAnalysis, which is the top researcher in kind of matters like AI data centers. They found that in May 2025, what is that? That's just 4 months ago, the new NVIDIA chips, the new platform GB200 racks, they had worse economics than the older chips by about 9%. By July, they were 1.52 times better. And by the end of the year, they believe these new chips will be 2.8 times better. And that's largely thanks to a lot of software improvements, let alone all of these companies getting these systems at scale and figuring out how to increase the uptime and all the other things. So, Austin, I know that this is a lot to take in. I'll pause here in a minute because I do want to give you a chance to react. But the main point here is it continues to show that, number one, not only is NVIDIA being able to deliver on this most important product ever, but number two, why a lot of this CapEx is increasing. Because if you're a customer, if you do not make this next upgrade, you might as well not be in this race, because these chips are so impressive. And this launch is going to be continuing to flow through. And as we'll talk about in other company earnings now, we're seeing all the downstream impacts of how this is rising the tide for all the other companies in the industry. So, Austin, NVIDIA, not a big earnings reaction. A lot of information, though, from these earnings about Blackwell being on track, being in many ways bigger than expected. And that has massive implications across every company in the portfolio.
My biggest takeaway hearing you talk about this and seeing these earnings is just a reminder of the scale and therefore the time cycle that a lot of these investments need to be considered. So we see AI news every day, so it feels like the news is happening, day by day, and we certainly talk about a lot of the news. But when we sort of take a step back, we've been talking about Blackwell for over a year, and yet most of these chips are still being used for inferencing, not for the next generation of models. And that makes sense. You have to build these huge clusters. You have to build new data centers. These models are hard to train. So we have seen Blackwell coming for a year, largely through the lens of being able to train these next generation models. And we're still not really there yet on the execution end. That doesn't mean anything is going wrong. That is just how long it takes for these things to hit the next cycle of this trend. So there's always a lot going on in the AI space, but we need to remind ourselves of some of the scale involved here to manufacture these extremely complicated chips, to ship the volumes necessary, to then make all these major interconnects in order to go train the next generation models. Takes a year, 18 months, 2 years. So you have to remind yourself sometimes of how long these things can take. And I love that stat from SemiAnalysis. I hadn't seen that, but that's really powerful validation for the potential of these chips here. One of the other things that we talked about was networking, right? So can you talk a little bit about the implication there? Because you have some positions in the portfolio that will directly benefit from the networking and the increasing build out. And we've talked a lot about, some of the new stocks you released, like Applied Optoelectronics and Credo. So talk to me a little bit about what you saw in networking.
Yeah, the earliest theme that we talked about on the show when we were launching a year ago was this growth of next generation connectivity, next generation networking. These AI data centers are going to have new demands, which leads to new winners. And we've tried to build a portfolio that's concentrated in these companies that see this next wave of growth versus ones who were more advantaged in the kind of old way of building data centers. So one area is NVIDIA made massive investments in networking. They bought a company named Mellanox. They bought them for $6.9 billion. It could be the foundation of $1 trillion, networking business. Everyone thinks of NVIDIA for their chips. What they build is complete solutions, actually, and networking is a key part of that. So networking had been disappointing for several quarters, kind of at the tail end of last year. But now what we saw is the prior quarter before this, it grew 64% sequentially. In their latest quarter they just released, it grew 46% sequentially. Austin, daisy chaining sequential growth like that is insane. It is absolutely insane. And the reason for this is number one, NVIDIA's released some new high-end networking solutions. Number two, as they scale these systems, these large systems with 72 GPUs each in them, is going to lead to a lot more demand for their networking solutions. The overall point of this, though, is that it's good for NVIDIA because, again, this business is getting quite large. Its growth is outstanding. It's much better than the actual, compute or chip revenue they're showing each quarter. But the other thing, this is a rising tide that's going to affect a lot of companies in our portfolio. And one final point, as you noted, there's still a lot more networking complexity for training that we are just beginning to scratch the surface on. So, while a lot of people look in the rearview mirror and say, I've probably missed the growth in a lot of these spaces, there's actually significant catalysts to come. So I think for the portfolio, that's big. The other thing, Austin, I do want to touch on, NVIDIA's really put a lot more work into sizing the opportunity. So what they're projecting is a $3 to $4 trillion build out in these AI systems or data centers, I should say, by the end of the decade, by 2030. That would really infer this year, NVIDIA quotes the largest hyperscalers have about 600 billion. When you look at that number and some other numbers you can flow into it, it would be that the overall market for them probably hits $1 trillion by 2027 or 2028. So a lot of people ask, okay, we've seen this growth. When does it flatline? What NVIDIA is projecting is we still have another probably 60% growth within the next 2 years-ish. So, again, for people saying, have I missed everything and behind it? How much is forward? They're starting to give numbers on that, which is very helpful, especially for Wall Street continuing to model this growth ahead for years to come, which will reflect NVIDIA's share price.
Right. And trees can't grow into the sky forever, but I would remind people that it was very easy 6 and 8 months ago to look at what at the time was probably, I want to remember, 350 billion of capex, and that seemed like an eye-watering number, and people were like, "Wow, how could it possibly grow from there?" And then that cycle, just that capex cycle, was accelerated. I believe in the hyperscalers to about 500 billion. We're seeing Nvidia saying it's about 600 billion. So the point is, from people thought we were hitting a capex high 6 to 8 months ago, and that cycle hit an acceleration lever. So at every point where it felt like these things were hitting the limit, they weren't. And just a fun stat to close out to put the size of this in context. NVIDIA is, the absolute bellwether of this industry. You had shared a great tweet with me that NVIDIA is now worth more than the entire German stock exchange, and that's because it actually earns more than the entire German stock exchange, putting out 137 billion in earnings compared to 115 billion compared to the entire index. Incredible.
There's all these stats, and the implication is always it's a bubble, but like you said, well, it's worth more, but it's earning more, and its growth is 50 times higher. So,
yeah, if you were to hear that stat on the surface, you would think bubble, but it actually tracks to profits, so it makes sense. Okay, a lot about NVIDIA, very dense segment, so thank you for all that. But the portfolio is larger than NVIDIA. You've got a couple other big winners in there, so let's talk about some of the earnings that we saw. Lots of big movements. One of the biggest, most impressive came out of Snowflake. Big step up in growth rates. I think it was up about 20% the day after. So what was driving this? Is this narrative? Is this reality? What are we seeing in the revenue mix that's resulting in this sort of enthusiasm?
Yeah, and as you know, we were a little denser on NVIDIA because it's going to impact everything in the portfolio. It's not just about NVIDIA. I'll be a little faster on these. We'll cover 4 companies that have reported recently. The big picture is kind of the winners keep on winning, the losers keep on losing. So for Snowflake, what we saw is they were up 20% the day after earnings. It was on a massive revenue beat. Their product revenue accelerated from 26% to 32%. They took their full year guidance up. Austin, the bottom line is we've talked about the fact that the companies that can see this acceleration from having true growth from AI products are going to receive premium multiples from the market. That's definitely playing out with Snowflake. I think what we are seeing a little bit is the platforms are seeing some of this growth first. The actual applications are a little slower, which we'll talk about with GitLab in a moment. Let's talk about Credo. Austin, some of the most eye-popping earnings numbers you'll ever see. I had to write them down. Revenue up 274% from last year. Net income up 755%. Their guidance for next quarter at a midpoint of 235 million. Wall Street was expecting 199 million. We are recording this before the market opens on Thursday, September 4th. It's up 13% last I looked. The only reason it's not up more, Austin, is because it's, again, like NVIDIA, it's been running
It's
up.
already been ripping. It's already ripped so much.
So, again, I talked about this NVIDIA networking segment in part because it is having such dramatic impacts across a broader space. We saw Arista Networks, which is a key networking company. We saw them blow out earnings. We saw Astera Labs, which is another high growth networking stock. They blew out earnings. So Austin is just this Blackwell cycle. It led to, as people were kind of getting a little overly excited for it, not realizing that, you had this ramping in process. They sold off a lot of these stocks at the beginning of the year. And now that the actual reality of this Blackwell refresh happens, they're seeing the growth rates, and it's led to these stocks being significant winners. On the losers end, Austin, what is there to say about Marvell? What is there to say?
It's we had talked about this, I believe, in our August 1st episode, and you had mentioned this was one of the more disappointing positions in the portfolio. It continues to disappoint. It's mentioned in the same breath as Intel. Now Intel got a little bit. I don't know if it's a parachute or golden handcuffs or whatever it is from the government, but there's a bit of a handshake there that maybe helping that other disappointing name in the chip space here. But Marvell has been high on promise, low on expectation. I'm sorry, low on delivery. So, let's talk about what we are seeing and why this is the most disappointing company. And you've talked about this as maybe the last quarter where they get a deferral here, and that the next quarter might be the one where we sort of got to call it one way or the other. But talk to me a little bit about that and what the specific earnings showed, because we did see earnings per share growth that on the surface are impressive, but it's sold off massive. The company was down almost 20% after earnings.
And there's always going to be companies that have every narrative right, but don't deliver in a way you'd expect. Qualcomm during the smartphone boom was the poster child of this. You mentioned Intel being at a lot of markets where, you expected more success, but never really putting it together. I am beginning to wonder if Marvell might be in that position. They're in the sweet spot. They've got great inroads into the booming areas of connectivity, AI processors, but the results are, they're frankly just trailing a lot of their competitors. If you want to say glass half full, when we look at the actual results last quarter, it was EPS growth of 128%, revenue growth of 58%. If you look at the Wall Street adjusted earnings for this year, that puts them at about 22 times what Wall Street's expecting. But the glass half empty is, number one, the fact that this was a quarter below Wall Street expectations. Well, I just talked about all the other companies blowing out earnings. So that's a troubling sign. And number two, that Wall Street continues to discount the company because they have big promises into the future. They have low execution. This quarter was another example of what appears to be low execution. They've lost a lot of content with Amazon, who's a major company, which has led to disappointment this quarter. And their guidance disappointing, which they attribute to lumpiness in their business. Like you said, Austin, where I'm putting them right now is I'm putting them in a hold. We will definitively not be adding to the stock even after that reaction. But what I want to see is they're claiming lumpiness for this quarter, a reacceleration at the end of the year, the final quarter. If they don't deliver there, we'll probably consider selling this position. I don't want to overreact because, again, it is a longer-term story. But I do need to be aware that we've seen some signs of customers pulling back on their relationships with them. We've seen them unable to meet some of their earliest projects, which doesn't speak as well to the long-term opportunity. So, Austin, on this one, it's just, like I said, do not add to this position right now, but we are also not quite ready to sell it because the opportunity is there. It's just, again, this is one we're going to need to be watching earnings next season like a hawk because it'll probably determine our long-term outcome with Marvell.
I mean, the company is saying lumpiness, and I believe that to some extent. But if you were to engineer a company that was perfectly positioned for the AI boom, it would be a company that delivered custom AI processors and connectivity, and yet they're not delivering. And look above at some of the other connectivity names we talked about, right? Credo, Arista, Astera, even NVIDIA's own networking figures that you talked about. This company stands out for its lack of delivery here. The entire industry is moving past them. If we were seeing some other players in this space talk about, talk in this same vein or see this sort of similar performance, maybe they get a pass for me. But Marvell stands out right here, right? They are perfectly positioned to benefit from this. This is starting to feel to me just like execution risk or execution challenges.
And you look at too, it matters how CEOs manage Wall Street and Broadcom. They've really positioned themselves well for the future, even with maybe some growth rates a little lower than some competitors right now. The stock's done excellent. The next company we're going to talk about, GitLab. This was a company that was down 12% heading into their earnings call, and the CEO did a great job of refuting a lot of the bear cases. It really cut down on the losses they had after hours. That might not matter in the long run. This is short-term how a stock reacts. But again, a CEO's competence at being able to manage Wall Street says a lot about their overall competence. And right now, I'm not seeing a lot from Marvell. But let's talk about GitLab, because this is the last, I would call it, disappointing stock in the earnings season. Like I noted, they were down a lot initially. It was due to weak guidance for the year. They guided for 939 million versus Wall Street expecting 943. That might not sound like a lot, but what it infers is that they'll have deceleration in the back half of the year. The last quarter was great. They delivered 29% growth. At their valuation, 29% growth is very outstanding. It is just, we are stuck right now in kind of a battle with GitLab, and this is across a lot of these SaaS stocks, where the company's saying AI is going to be something that generates a lot of incremental revenue for us coming up across the next year. But Wall Street worries how their basically contracts with customer works as per seat licenses. What Wall Street worries about is there's going to be a reduced number of developers as AI takes hold, which hurts their economic model because they won't be able to sell as many of these, per seat arrangements. Overall, I thought it was a very good quarter from GitLab. I think in terms of, I said I would not be buying Marvell right now. I would hold it. I am still a net buyer of Marvell in the low 40s. I think that they will be able to prove out some of their opportunities across the next year. I don't think this latest quarter changes anything. So again, two stocks there. One, I'm pretty troubled by the reaction the day after earnings in Marvell, and another one, GitLab. I continue to be a believer in the longer term story.
Yeah, this per seat revenue challenge. You and I had talked, I forget, maybe 2 or 3 episodes ago about how SaaS per seat licensing was considered the best business model on earth. That's largely threatened in the age of AI. We're seeing that narrative come home to roost with GitLab, and also like the poster child Salesforce, Monday, and others, Monday.com, other similar companies that are per seat licenses. I wonder if that's also a big part of the Snowflake story, where we're seeing more consumption-based models doing a lot better. Per seat and consumption-based are different models, and maybe per seat is just, there's a dark cloud of uncertainty. People are not sure if the per seat model continues to work as well as it has in the past, but consumption models seem to be doing a lot better. Okay, that's it for earnings. Eric, I want to move on to a portfolio review. 1-year anniversary here of the portfolio. Let's talk a little bit about the returns you've seen. All returns here are reported as of this weekend. So I'm seeing an average recommendation up over 32%. What else? I mean, this is your victory lap here. I think you've had a great first year here. Made it through the DeepSeek moment, made it through the tariff sell down here. We're seeing some big gains in the portfolio. What are you seeing?
Yeah, I think what's important to talk about is what's worked, what hasn't worked, where we would like to improve the next year. Also, I think one thing that's worked tremendously well is just owning the most obvious names, which, that's not much of a victory lap in some sense, but NVIDIA, since our first recommendation, as you noted, when we started buying these stocks last year, it's up 46%, Taiwan Semi up 35%, Broadcom up 64%. If I could sign up for those kinds of returns, I would do it any single day. These companies were kind of the no-brainers of the AI space. And as AI has as we noted, it's the trajectory has gone materially better since we started. They've performed. So the question for everyone listening is probably, would I still buy today, right? It's great that you talked about a year ago. Is it still a buy? I would say, especially if we're seeing some shift out of momentum, some selling in some of these names. If we were seeing Nvidia down around 150, I would absolutely still be a buyer of at these points. We talked about their roadmap being on schedule. One thing we didn't talk about from their latest earnings, some of their diversification strategies, like Sovereign AI, they gave us numbers on that. It's $20 billion, doubling with a big growth map. I have it. We've got Robotics, which we're going to talk about in a little bit. I have schedule. So I see a lot of their diversification maybe happening sooner than we expected. And Taiwan Semiconductor is going to be, I still think, a good value at today's levels for the same reasons. It is the arms dealer that wins from all of these AI markets, whether it's data centers or robotics. So I think having these stocks in your portfolio makes a lot of sense. Software, generally, we've done well, especially as the market has sold off in this space. Cloudflare up 51%, Snowflake up 44%, Uni up 54%, GitLab maybe the one outlier, but we had re-recommend that at prices around today. Austin, I was in Dublin for Investicon, and one of the stocks I highlight there, even at its high price and high valuation, is Cloudflare. It just has a fantastic opportunity to be the toll booth for the AI age, being a facilitator for these AI to AI interactions. They'll get money. I believe they'll build the right platform for being able to give content creators value for training, but they'll also have a massive growth vector along running these models. So again, the story I think is basically that a lot of these platforms are doing very well, and many of the kind of application companies have been slower to see an acceleration from AI, but we focus on the platform companies. So we've done well there. Austin, I don't know if I want to pause here to let you get any thoughts, or we should just keep moving
Sure.
through the topics.
Well, I love that you ended on Taiwan Semiconductor in the first section about sort of an obvious winner. I remember about a decade ago, Simon Erickson called Taiwan Semiconductor the most important company on earth. And it seemed so obvious at the time, but like a narrative that everyone understood. And since then, I don't know, the company's probably gone up, gosh, I don't know, it's at least up 6, 7x since then. Also, hey, shout out to Simon. If anybody didn't listen to the last episode with you and him, really great conversation there. But I take from that things can seem obvious and they can still be fantastic investments at the same time, right? And NVIDIA, Taiwan Semi, Broadcom fitting into that bucket. Cloudflare as a toll booth for the agentic age, I love that. I would also say, they're both a toll booth and a gatekeeper. I mean, I think the role that they play in also protecting people from agentic AI attacks is a whole other element to why Cloudflare is so well positioned here. One of the other sections of the portfolio that we've talked a lot about on this show and we discussed through the lens of NVIDIA's earnings are your data center positions. So let's move on a little bit to those, that bucket of stocks in the portfolio, the data center and optics winners. We've got Fabrinet, Credo, Lumentum. We talked a little bit about Marvell and Coherent. What is the performance that you've seen out of those positions in the first year?
It's generally good now. It was, as we noted, it's looking at returns versus living, experiencing them. It's been a roller coaster, a lot of these stocks. This part of our portfolio was dragging the entire portfolio down to very red levels in January and April. Of course, if you played out, let this Blackwell cycle happen, we're kind of on the other side now. The performance has been great. Credo, probably after earnings today, will be up 400% since we recommended it. Fabrinet is very well positioned for the future. And our most recent re-recommendation after a sell-off is up 53%. Lumentum's up about 60%. As you know, there have been some losers. Marvell is one we're deeply disappointed in. Coherent, from our second recommendation, is down, or kind of net flat since we had first recommended it. But Austin, again, I don't need to rehash. I think Blackwell continues to be a large catalyst, and we're pretty comfortable with this part of the portfolio right now. The biggest opportunity I see, and one area where I'm probably the most self-critical, would be how we did with power bottlenecks. That's a theme we explored from some of the earliest podcasts on the show. What we had bought in it was companies mostly involved in the data center build out and also kind of the liquid cooling side. Vertiv, Schneider Electric. We recently introduced Tecogen in our most recent podcast. One area I do want to highlight, you look at the power density of these racks that are coming in. For H100s, it was about, I've got the numbers right here, 30 to 45 kilowatts. For Blackwell, it's going to be about 132. For Rubin, it's expected to be about 600. So what that does, Austin, it introduces 15 times the need for heat rejection. So there's exponential numbers all over AI. I do think this opportunity around how you're building out this new architecture and the needs for this thermal management is still underappreciated. I could see adding more stocks to this because, again, I don't think the stock price movement has moved with kind of this ramp. And as we talked about, we saw it with Blackwell and a lot of these networking stocks. As much as it should seem obvious, it's often not, and people index onto older technologies. So I think we will probably do some additions for more thermal management. The other thing, again, we missed things like probably Vernova, the independent power producers. We'll continue looking at opportunities around kind of how we produce this power, how we take data centers off the grid. So I think a lot more to explore, and I wish we had performed better because there were some stocks that went up 100, 200% that we could have recommended near the start, but that was just kind of a miss on our part. So that would be my critique for the portfolio.
Well, no portfolio is perfect, but wrapping it all up so that people can understand what the aggregate performance is there. I'm seeing returns of about 15% on the entire portfolio for the year, but that needs a little bit of context, which is this was an actively allocated portfolio throughout the year, and there's a lot of cash drag there with you not investing all of your cash up front. So able to achieve a pretty impressive 15% 1 year return despite having cash drag and having to allocate throughout the year. So congrats to you and any of the listeners who've been with us since the beginning here. And just to summarize there, the large baskets that are represented in the portfolio are the software agentic cloud leaders, data centers, power bottlenecks, connectivity. And Eric, as we enter into the second year, you are mostly allocated. I think you've got a little bit of cash, and you're going to put some of that to work at the end of the episode with a new position here. So, but before we get to that, I'd love to hear, as we enter year two, as you've got a portfolio that is mostly allocated, what concerns you the most? Because we now find ourselves in a position of not having the dry powder to make huge bets on swings. Now, I'm thinking about your big bets that you made on Amazon and Meta. Ultimately, turned out to be positive for the portfolio, but at the time were challenging because they both sold off right after putting that capital to work. So now that you find yourself with less cash on the table to make those big swings, what worries you going into the second year?
Yeah, that's a good question. I would say we've talked about overall valuation. Stocks remain kind of near historically high levels. I do think we'll continue looking at a lot of small cap opportunities. Our next guest on the show, I'm actually filming it later today. We're going to have that drop, I believe, next week. It specializes in looking for a lot of small cap opportunities. So I would expect, we might have 10 plus ideas on that show. It'll probably factor into our next buys. The economy in general is fairly troubling, especially given these valuations. We've talked about that AI spending has outpaced consumer spending, which is a huge flip for the US economy as a whole. I think for the market to continue seeing relatively strong returns through 2027, we're going to need to see some acceleration, or I should say 2026. We're going to need to see some consumer spending because, this AI story alone isn't going to be enough to drive things. The one thing I would say, though, I'm not as concerned. A lot of people would expect me to maybe be more concerned about a slowdown in hyperscaler spending because of the stats we talked about today and the need for a refresh in Blackwell, and also just the next phase of AI and how hungry it is for, far more tokens. When you look at going from a query to actually building out these systems, I think the demand is going to stay relatively robust from the hyperscalers and spending on these data centers. So I'm not as concerned about some sudden cliff in any of this data center spending.
And Eric, you had shared some really good data earlier about just the token demand that I thought really helped illustrate what this ramp looks like. Do you mind going into like some of the functions that people will be using AI for, and as you move from like Q&A to complex code to like truly agentic workflows, there's a logarithmic, or I'm sorry, exponential increase in token usage as well. The Not all of these functions are created equal. So could you talk a little bit about that and why this hyperscaler spending needs to continue to meet what we see as the future use cases for these models?
And you see this with the MIT study that a lot of the initial use cases for generative AI are essentially, like you said, this basic Q&A. And where we are at in our personal business and where we're looking at for a lot of our AI projects, it becomes a question of economics around these, multi-step workflows. So Austin, what we have is, I looked at something recently, adding up the token usage. A basic chatbot Q&A is 50 to 500 tokens. Basic code assistance is 500 to 2,000 tokens. But once you get to writing complex code, you're at 20,000 to 100,000 plus tokens. And multi-step agent workflows, we're talking 100,000 to a million plus tokens. So again, these next generation systems are going to enable these multi-step agent workflows at scale, make them far more economical. And again, this is what everyone is driving towards. So until we have these kind of multi-step agent workflows at scale, it's really hard to evaluate the effectiveness of AI. And to get towards that being economic requires this massive refresh cycle into things like Blackwell GPUs.
Eric, thank you for the context on tokens. I really appreciate that. And now, look, I want to move on to the main event for me, at least, which is new portfolio buys. I'm the most excited about this one because this gets us into robotics. We're talking about lidar. I'm team robot here, and I'm really excited to start making some portfolio moves in that direction. So I'd love to see what you're doing. Talk to me about this company and just a little bit of a context for our listeners. This is going to be a smaller position, which could either be interpreted as a starter position. We want to learn more about this company and follow them, and also just riskier as this is a smaller market cap company. This reminds me of your Tecogen, Applied Optoelectronics, and GitLab initial positions. So, Eric, where are you putting the money? What's coming next to the portfolio?
Yeah, the company's name is Ouster. It's ticker symbol OUST. We've talked about this company in the past, so I think a lot of listeners will be familiar with them. Austin, as you said, you're Team Robot. I'm Team Robot. I think big things are happening in this space. The rate of change is really incredible. I think it would be a mistake not to make some smart bets with your portfolio for the growth of the space. As you know, we're going to start with 1% of the portfolio, $5,000, but we do want to sprinkle some bets because the upside in robotics is going to be great. Now, why is the upside so great? Well, as Jensen Huang has said, everything that moves will be a robot. We talked about stats. Amazon's going to have more robots than people soon. You look at the efficiency they've built into their factories. I believe the rate of packages per employee is up more than 15x in the past decade. That's thanks to robotics. And we've previewed things like Figure AI in recent episodes with very incredible, mind-blowing, I would say, demos of robots being able to sort laundry, fold laundry, do the kinds of very complex tasks that were thought unthinkable just years ago. And they're doing it all with data because the underlying neural networks are getting so good. So we look at Ouster itself. It's a leader in LiDAR. If you go back and you look at a 5-year chart for this company, it's a train wreck. And the reason is just about every single company in this space was taking advantage of SPAC mania, and they were IPOing. If you look at a 1-year chart for this company, it's very good as it's kind of dawning on people what kind of opportunity they have. So, Austin, this is a $1.6 billion company. They've had a very good recent track record of delivering on growth performances. Wall Street sees them hitting $145 million in revenue this year, $198 in 2026, $282 million in 2027. That's a very steep growth curve. I believe they're going to be able to do this. And, again, they're not building all of this on speculative markets. They've got autos, they've got an industrial segment, they have robotics, which I think we could see incredible growth, and they have smart infrastructure. Their solution itself is something called digital LiDAR. It's basically moving LiDAR into a silicon chip. They also have software as another part of their overall solution. Austin, it's hard to evaluate how this company might compare to competitors, but when I look at revenue growth, the proof's in the pudding. They are delivering extremely well. So I have a lot of confidence that they have a differentiated solution. The other thing with Ouster is a lot of their competitors are in China. We've talked about this geopolitical situation, building your supply chain and being able to use American companies. They've moved their production to Thailand. It's going to be a competitive advantage for this company. So, Austin, I'll just wrap it up with a bow. And again, maybe we can do a little bit more of an in-depth video. We're going to try and do one on Techogen as well to our YouTube channel. But just to say, I think that this is a company that's about to see significant growth. Everything that's a robot is going to need sensing capabilities. LiDAR was once a self-driving story. Now it's a robotics story. I like them as a foundational company, and I like their opportunity to have significant upside in the years ahead.
Eric, thank you. I love this. I'll probably be in it myself. So there you are, listeners. $5,000 in Ouster Technologies, and just to it's very easy for us to get curious about what is the winner here. Is it vision? Is it LiDAR? And we're thinking mostly in the context of self-driving, myself included. But the potential of LiDAR is so obvious. We've seen how effective it is in self-driving with Waymo. It was an expensive and heavy and complicated technology, but the results are there. And when you have extremely valuable, potent technology like this, it becomes more affordable over time. It becomes more power efficient over time. It can then move into different applications like robotics and industrial. And that is one of the trends that we're betting on here, that LiDAR is going to start becoming, smaller, more cost effective, more power efficient. And then when you layer the AI processing on top of it, you can open up all these other applications. So I love this position here. We don't need to know whether or not it's vision versus LiDAR, because the answer is they're probably both going to win, or it's a hybrid model and in different contexts and different use cases. So I love taking this position. I love moving into robotics. Eric, thank you so much. Congratulations on the first year with the portfolio. Just a final request to our listeners. Reach out on YouTube, reach out on Spotify, email us questions. We'd love to hear from our listeners. What do you like? What do you not like? What questions do you have? Engage with each other. We do want to try and build a community here in the second year of the AI Investor Portfolio. And with that, we will release you at under an hour here, Eric. I know you've got a lot of work to do today. So thank you for your time, and thank you to our listeners.
The AI Investor Podcast is for educational purposes only and should not be considered investment advice.